Money Series is open access to financial education for all within a nonprofit. We have 3 separate venues. There's the library where you are today, obviously, a very wonderful venue with video recording of this program. And we take these video recordings, we put them up on moneyseries.org, which is the website. And you can see that there are multiple presentations up there. So all of the programs have a video replay. So if you miss it, you can certainly come to the website and watch it. And if you miss something during the talk, you can always watch it again and pass it along to those who are unable to attend. In addition to that, we take the recordings and we put them up on channel 189, the open access TV station on the Charter Spectrum cable system. And those run, I think, 3 different times during the week on channel 189. I think Tuesday, a Friday, and a Sunday. I never can keep track of the exact schedule. The programs are usually about 45 minutes to an hour, and after the program is done, we do Q&A. And that's especially the case when we're dealing with a live recording, because we want to make sure that we don't have an interruption during the talk, and there's no way for us to mic the questioner. So the best thing to do is wait for the Q&A. And we've got little cards in the back for you to write down your questions so you don't forget them. And keep in mind that your question may very well be pertinent to your neighbor, but it also could be so specific that I will be kind and I will defer answering your question if I feel that it's really something very, very specific for you and it won't really pertain to anybody else in the room. So with that, I would like to launch into the actual program today, if my clicker works. There we are. So this is going to be a talk about the tax law. And I wrote a column. I should kind of preface it. I write columns for the Record Eagle in addition to my normal business life. I write a column a couple times a month, and in the business section on Sundays and Wednesdays. And lately this year I've been a little obsessed with the new tax law. It's got a lot of new stuff in it, and I want to make sure that I explain it to the public, because there are certain things that you may want to consider doing to take advantage of the tax law. And I'll say it another way, there are certain things that you used to do that were beneficial that if you continue to do it that way won't be as beneficial to you from a tax perspective. So you have to change your habits a little bit. And so you'll see that as we go along in the presentation. So the new tax law, learn all about it. It's quite a tax law, and I'm not going to make many comments about what it means for our country, other than to say that it looks like starting next year or so we're going to be butting up against trillion-dollar deficits at the federal level for as far as the eye can see, and that's assuming that we continue to have a growing economy. So, well, I'll let you read between the lines on that. We don't really know how this is going to work out, but it has an impact today in the here and now for taxpayers. So I'll start with the biggest change of all before I get into some specific changes. The biggest change is that overall tax rates, when you look at it bracket by bracket by bracket. So brackets go, if you look on the left and the right column of these 2 charts, you've got filing as a single person, filing jointly or married, and you've got income brackets heading up on the right and the left. You can see that the rates look like they're about 3% lower across the board. So whatever income level you're on, whether you're filing jointly or filing single, you can pretty much say that it's about a 3% reduction in the overall rate that you're going to pay. It's a little different as you go into the higher and higher brackets, but really for the bulk of taxpayers, that's a pretty good rule of thumb, 3% lower. So that is a pretty large decrease. In addition to that, the next really big change, and it really impacts everybody to some extent, is that the standard deduction has been essentially doubled. So I'm going to talk a lot about deductions, because when you think about it, the government says add up all your sources of income, and then they say, well, let's go ahead and subtract some things. And there are 2 things they can subtract. They can subtract itemized deductions, and we're going to talk about what those are. And then you take all of your list of itemized deductions and you compare it to the standard deduction. And if your itemized deductions don't add up to be bigger than the standard deduction, then you're just going to go with the bigger number. In the world of taxes, you want as big a deductions as possible. So if the standard deduction is big and bigger than your itemized deductions, then you don't have a lot to keep track of. And the biggest change in this tax law is the government said, we're going to double your standard deduction. So you can see what the ramification of that is. It means that it's a large number of people that used to itemize, and looking through this room, we've got a pretty good sample of people here. About 30% of all taxpayers itemized under the old tax law last year, 30%. Now they're estimating it's going to be close to 10%. So 9 out of 10 people are going to use the standard deduction, this new bulked up standard deduction, which means things are going to get a lot easier to keep track of, because the fact is you're not going to have to keep track of all those little standard deductions that you were thinking about before for many people. So I have a little icons. I always use icons to kind of guide the talk. The hurdle of the deduction relative to your standard deduction now is much, much higher. And age 65 is a magical age still, because when you hit 65 and older, the government not only gives you the standard deduction, but it gives you additional deductions on top of it just for being a little older. And so the actual number, when I look at that $24,000 for a married couple, standard deduction, if you guys can see that, 65, it's actually $26,600 for a married couple. The $12,000 standard deduction is really $13,300 for a single person over the age of 65. So they've really created a big, tall hurdle in terms of itemizing. I'm going to go through the major changes in the itemized deductions. So not only did they double it, which is a huge change in and of itself, they also reduced down what itemized deductions can be. They applied restrictions and eliminated some. So they made that leaping over the hurdle much more difficult. So first off, charities. Giving money to charities is still considered a deductible expense. Nothing really changed there on the surface. But you're going to see later in this talk something changed dramatically there. But giving money to a 501c3 and other tax-exempt organizations still can be a deductible expense. Mortgage interest, they did change things in there, but for our purposes, largely the same. There are some nuanced changes, and I'm going to go through a lot of detail tonight, so I'm not going to talk about every tiny little nuance. But mortgage interest still deductible, so they still are incentivizing people to buy homes. I mean, if you think about why they give an interest deduction, a deduction for interest, it's to get people to buy things and to do things. The government wants to have you buy homes, sell homes, furnish homes, maintain homes. All that pushes the economy forward. We all saw that in 2008 when it didn't work out. It shut everything down. Healthcare expenses, out-of-pocket medical expenses are still deductible, but they still have a limitation to them. The limitation is they compare it to your overall income, and they tell you that the first 7.5% of your income, whatever medical expenses you have up to that threshold, not deductible, but the expenses above that threshold, still deductible. And so they didn't change that at all. It's 7.5% is that threshold, and that still applies. So if you make $100,000 of adjusted gross income, the first $7,500 of out-of-pocket expenses will not be deductible, but above that, you'll have a deduction. In a few years, it moves up to 10%. So the first $10,000 won't be deductible in that example, and anything above it will. So they're slowly choking that one off a little bit. Really, that applies in serious ways for people who are in a nursing home near the end of their life. That's when I've seen it the most with my clients. They've got very large medical expenses that are deductible. Down below, we've got property taxes and state income taxes. These are called SALT. That was the phrase for state income taxes and property taxes. And those are still deductible, but they've applied a very, very strict limit on it. You cannot have those two things add up to more than $10,000. So some states, New Jersey, California, and if you're really, really tuned in, I'll tell you that those are Democrat, propensity to vote Democrat states. So they're blue states. And so the red Republican bloc really put a restriction on things that may impact blue states more than red states. So it's kind of funny politics, but $10,000 is the limit. In the past, it was unlimited. So if you have a high income tax state and you also had a high property value state, you had huge deductions. Now they're just slicing it off at $10,000, hobbling itemized deductions and comparing it to a doubled standard deduction. And then lastly, I'll tell you that there's a thing called miscellaneous expenses. This is all on Schedule A, in case anybody is a dork enough to look at your tax return closely, or if you do it yourself. Schedule A is where you list all these things, and there's a section on there called miscellaneous expenses. Well, miscellaneous expenses no longer exist. Job expenses, moving costs for a job change, investment management fees, something very near and dear to my heart, no longer deductible. Tax preparation fees, no longer deductible. Safety deposit box, no longer deductible. All of those things are gone completely. So for some people, that's not an insignificant thing. It actually lowers the itemized deductions compared to a much higher standard deduction. So those are the main shifts, the main changes. Property taxes and state income taxes capped at 10, and then you lost all your miscellaneous expenses. Other major changes that may not apply to anybody in this room, but it may actually apply to a very small fraction of a person in this room, possibly, if I'm going by statistics alone. The exemption for estates for the gift tax, for the estate tax, is now $11 million for each individual. In a married couple, that means that $22 million, I'm rounding, $22 million of value is not subject to the estate tax anymore. That was 11-ish, 11.5 million before the tax change. Now they've doubled that to 22 million. So for anybody who has that much in their estate, this was a massive change. And I can say from a pragmatic standpoint, I'm not supposed to really go off because we have a lot of stuff to go through. I will say that the overall revenue that the estate tax brought in was something like $40 billion out of a $3 trillion budget. So 40 billion, 3 trillion, it was nothing. It had more of a societal impact than it did a financial impact. Well, we've taken the societal impact and just sort of threw out the window. It's okay to pass along $20 million estates to your kids and grandkids and their kids. And so it is what it is. But that's a very, very big change for a very small number of people. The alternative minimum tax actually did hit more and more people over the years. And I'm not going to get into detail with it, but effectively, it still exists technically. But when you actually apply it to people's lives, it's pretty much gone. So whoever used to pay the alternative minimum tax is very likely not paying anything like the alternative minimum tax. And all that was, hey, what's the normal tax code? What's my tax bill going to be? And oh, there's an alternative tax code that's a very different calculation. What's my tax going to be on that idea? Let's compare the two, and you're going to pay the bigger one. Well, the whole thing was set up back in 1968 because there were like 300 families that were making a ton of money that weren't paying any taxes. And so they set up a law that basically was to capture those 300, 400 families. Well, the years went by, and it slowly captured more and more and more and more people, kind of like higher middle income people, professionals. And that began to be a problem. And every year or so, they would try to fix it a little bit, but it would always choke off more and more people. This tax law, they essentially just eliminated it for all intents and purposes. Last major change, child tax credits. This is actually a really big change, and you're going to see it in a few examples that I give. The child tax credit was doubled, and it applies to a lot more taxpayers. So it has a really, really big impact on, and it was almost put in place as a fix for something bad that was going to happen, a tax increase on families with kids. So they instituted a doubled child tax credit to sort of fix the problem that was going to occur. And by the way, that one was put in place by Marco Rubio, who I believe is a Catholic and probably has a bunch of kids. So he was able to get that one in at the last minute. The property tax and state income tax, that came from Senator Susan Collins, Maine, because, well, she had a tie-breaking vote, basically. So all these senators at the last minute started adding things that would make them a hero. So Susan Collins did that. Marco Rubio did that. And so that's how this worked. We had basically 1 and 2 and 3 people basically writing our tax code because they could end the whole bill or make it last. So, okay, I'm going to go through an example of a couple of 3 examples of the changes between the old and the new law and how it impacts the taxpayer. And you may see yourself in some of these examples, and you may not. If you don't, hopefully you'll see some of the aspects of it. Old law, really big family for today's purposes. I come from a family of 6, so a family of 3 is not that big, but of 3 kids, but it's pretty big. Big family, and I'm going to go through their income on the left side, which is they make about $83,000 of wage income at their jobs. They've got $7,500 of interest income from their savings. They make IRA contributions of $5,000, and it comes down to $85,500 is their gross income. They have deductions that things they've kept track of in the past. They have property taxes and state income taxes. They give to charity. They have a mortgage, so the mortgage interest is deductible. They have health expenses to some degree. They have investments that some manager is managing and charging a fee. And they have someone do their taxes for them. So I kind of gave you a flavor of all the different kinds of itemized deductions. And all of that added up to $30,000. And they compared it to their standard deduction. And their standard deduction back in the old days, way back in 2017, was $12,700 for this couple, a married couple. So when you compare the two, that clearly they have leapt over the hurdle of the standard deduction back in the old days. And so they are itemizing using Schedule A, and they're keeping track of all this stuff. So they've got this burden of gathering up all this paperwork and sending it all to their tax preparer and keeping track of all of it in February when it all comes in the mail. Now, they also have another set of subtractions from their income. They have what's called personal exemptions. And I'll tell you, it's one of the largest changes that I didn't highlight before. We're going to see that this goes away in the new tax law. But for this example of the old law, they had $20,250 of personal exemptions, all 5 of them, just for being living, breathing humans. So it's a bizarre thing when you really think about the tax law. It was, you're alive, so we're going to subtract $4,050 from your income. Why? I have no idea. They just made up this thing. So you have 5 people breathing in the house. Let's just subtract your income from your taxes before we calculate your tax bill. But so there it is, $20,250. So they've got about $50,000 that doesn't count as taxable income. So they subtract $85,000. From $85,000, they subtract $50,000, and they end up with this $35,000 taxable income. And I calculated it under the old tax rates. They owed $4,355 in federal taxes. But they weren't going to pay that because the government said, well, you've got 3 kids under the age of 17, and each one of them gets a $1,000 child tax credit. And the credit is just simply a subtraction from the tax bill. So we subtract $3,000 from that, and they pay like $1,300, $1,355 under this example. So that's the old world. Here's the new world. Same exact income, so nothing's changed on the left. Inside the itemized deductions, notice I've crossed out the investment fees that they paid. I cross out the tax preparation fees. And when I add it all up now with those things crossed out, the itemized deductions added up to be $23,000. This is all a hypothetical example. You compare it now to this very new doubled standard deduction for this family. And you can see that $24,000 exceeds the itemized deductions. So now all of a sudden this family finds themselves in a very different picture. We don't have to keep track of all this stuff in the mail. We don't have to hand all that to our accountant. We're standard filers. We're going to use the standard deduction. Much, much simpler. Now, flip over to the far right on the screen. Notice that there are absolutely 0 personal exemptions. They don't exist anymore in the federal tax law. So they lose a huge pile of exemptions, $20,000. So on the face of it, they had, flipping backward, $30,000 of itemized deductions and $20,000 of standard of exemptions. $50,000 was subtracted from their income. Now we're down to 24. So you can already see the problem that Marco Rubio solved, which is, are you kidding me? The same income, less of a subtraction. I know we have lower rates, but this is not going to work out well. Remember, 3% lower rate. But you look at this and you realize you've got a problem brewing. And so they fixed it by, you do all the math, and it says, well, you owe $7,000 of taxes. Compare that to $4,000 from before. $7,000 now. But we're going to subtract off $2,000 for each kid as a tax credit. So you knock it all down, and this family pays slightly less than $1,000. So they went from $1,300 to $999. So this family sees a tax cut of a few $100s. Percentage-wise, 25–30% reduction. Big deal in terms of percentage. Dollar-wise, $400. So that's an example of how the tax law has changed. I would say, as a summary of this, simpler tax preparation for this family by far, and a slight tax cut for the family with a family of 3, making a moderate income. Okay, moving on to the next example. Old law, a single retiree. So I'm telling you right now, I put this in here because I get criticized whenever I do these talks. I always talk about married couples. And there's always someone who walks up to me and says, why do you always do that? Can you please tell me something about a single person? So I'm doing it. So single retiree, income down the left side, $67,000, Social Security, IRA distributions, you rent out a house you might own as a rental property, pension income is flowing in, and you end up with $67,000. Itemized deductions, old law. To add them all up, it's $15,000 for this person. You compare it to that small, tiny, minuscule little standard deduction of $7,950, and they're going to use the itemized deductions. They've got all the work of keeping track of it all. And then you have your personal exemption that existed back in 2017. You do the math on all of that, federal tax of a little bit over $6,000, $6,260 for the single retiree. Fast forward to now, same exact income. You look at all the itemized deductions, cross off the investment fees. I keep saying that. It's almost like I'm a glutton for punishment. Investment fees, they don't count. Tax prep. You go all the way down, and you see the standard deduction is $13,300 for this retiree. So I'm saying the person's over 65. Otherwise, it'd be a little bit less. And you end up comparing it to the itemized deductions that are now lower, and you now are becoming a standard filer. Much, much simpler. You don't have to keep track of anything. The personal exemption, completely gone. You do the math on this, $6,063 is the tax bill. $6,260 before, $6,063 in this example. Very small tax cut. About 80% of all taxpayers are going to get a cut of some level. Some of them will be really small, some will be larger. And we're going to go through an example of one where it's larger. But there are some people that are actually going to see a tax increase, and it's a small number. I can tell you, it's retirees with high income that used to have big deductions. They, when you break it all down, they're going to pay a little bit more. Okay, third example, big family number 2, but this big family also are big earners. So they're not making $83,000 as a couple, they're making $195,000. They have more savings, so they've got more interest income. Their IRAs and 401ks, they put away a little bit more. They end up with this $188,000 of gross income to play with. And they look at all of their itemized deductions under the old law, and it added up to $30,000. So they had probably a mortgage, they had investments, they had high property value because they probably had a valuable home. Property taxes were probably high. Gave money to charity because they had disposable income. And it's $30,000, way higher than the standard deduction back in 2017. Then they also get the 5 personal exemptions because it's a family of 5 still, and so they have $20,000 to subtract there. So they've got that same $50,000 to subtract off of this much bigger income. If you do all the math, they owe a federal tax of about $26,000. And I subtract off 0 for child tax credits because under the old law, and some of you might gasp when I tell you the next thing, under the old law, when you made that much money, your ability to have a child tax credit was phased out. Started phasing out once you made like $110,000 as a couple. And it phases out completely by the time you get to like $150,000 of income. So they were completely phased out. They don't get a child tax credit. So they pay $26,000 in federal taxes. It's not a small amount of money. It's a large amount of money. But it's still $26,000. Fast forward to today, same exact income on the left. Itemized deduction story is the same I've been telling over and over and over. Because they had some things subtracted out of their itemized deductions, the standard deduction applies to them. So everything's really simple for them too. Personal exemptions completely gone. So they're in that same situation as that other family. But when you calculate their tax, they actually pay $28,000, which is $2,000 higher than the other than last year. But this family actually qualifies for 3 $2,000 child tax credits for their 3 kids. So they get $6,000 tax credit, and they end up paying $22,000. So $26,000 the old law, $22,000 the new law. They get a $4,000 tax break. Their qualification for a child tax credit is the result of increasing the tax credit to $2,000 from $1,000 for every kid, and then applying the phase-out after $400,000 of joint income. So this family is being helped by the government significantly for having kids, and they no longer make too much money for a child tax credit. And that we can definitely thank Marco Rubio for, that one. And it has a pretty big impact in terms of a tax cut, $4,000. So this right here is sort of the end of what I would say are my before and after effects. And the biggest story on it is tax simplification and the child tax credit for families. And I'll tell you that everybody in this example got a tax cut of some magnitude. There are few people that won't. I mean, out of 10, probably 2 that'll see a small increase. But generally speaking, it clearly was a tax cut for the aggregate country. Now, the one casualty in all of this change is that people are used to, and I'm going to talk about a couple tools here relatively quickly, people are used to giving money to charity and expecting a deduction. It's kind of become part of the pitch for nonprofits to say, you can give us $1,000 or $500 or $100 and you get a tax deduction. I will say that this whole talk, it's not lost on me that the reason you give to a charity is because you want to give to a charity. It's not because of the tax break. The tax break's a nice little icing on the cake, cherry on top. So we want to put the cherry back on top by giving you a couple ways to change your habits of giving so that you can actually get some level of a deduction. So, very first tool. The problem, I described it, which is you don't get a deduction because when you give money to a charity and you write a check, you get to put it on your list of itemized deductions, but the comparison to the standard deduction got harder and harder and harder under the new law. So you gave money, it used to be deductible, but for all intents and purposes, the standard deduction was always going to be $26,600 for this example. So it didn't really matter that you gave $3,000 to charity. You could have given $4,000 to charity. In fact, you could have given $7,000 to charity, and it still wouldn't have mattered. You have your itemized deductions didn't add up to enough to exceed the standard deduction. So $7,000 is where it almost gets about even for this example, and you still haven't gotten a deduction. So giving a little more than usual still might not meet the threshold of the standard deduction. So the solution is to bunch your giving. And when I say bunch it, I mean think about 2, 3, 4, 5 years of gifts of charitable intent, commit to it, and use a vehicle where you can put that money away into the vehicle, and then you can get at least a partial deduction for that donation. Then you dole out the gifts over the course of time. So you do it all in 1 year. You bunch it together. There is a tool for this called a donor-advised fund. And I'm going to talk to you about what a donor-advised fund does and how it functionally works. But hopefully you all understand what the reason it's the power of bunching is, that you're literally taking 5 years of your gifts or 3 years of your gifts, whatever it is that you need to get yourself into an itemized deduction position. You put it aside into an envelope called the donor-advised fund. It gets invested, moderate, conservative, whatever choice you want in terms of investments. And then you slowly dole it out over time. When you dole it out, you don't get a deduction at that time because you got your deduction all in the beginning. Okay? These are new tools that have been developed by firms like Schwab and Vanguard and Fidelity. There are donor-advised funds all over the place, and they're relatively cheap. They used to be reserved for people with lots and lots of money. Not anymore. They're totally democratized now. Anyone can have them largely. Okay? You can fund it with as little as $5,000. You can dole out money as little as $50 at a time. So the way it works is you're the donor on the left. You make a bunch of gifts all into the donor-advised fund with a company like a Schwab. You are in charge. You are the advisor. You can advise Schwab to give money to Father Fred, to your church, to some qualified nonprofit organization. You send in a piece of paper and you make a grant request. So you're telling Schwab, I would like you to take the money that I put into this envelope and I'd like you to give it to my church. That's my advice to you. And Schwab takes your advice and they write out a check and they send it to you, or they send it directly to the charity. And they have a little letter that says it came from your advice. So you get credit from the group that you've given to. So you make grant over the course of time, little tiny micro grants. They're all the reason I'm talking about this as being advice as opposed to a directive is that you don't have any control over the money technically. That's why you got a deduction. If you had control over it, you wouldn't have gotten that deduction. So you've relinquished control, but you've got someone's ear. Schwab, Vanguard, Fidelity, they're listening to you, and they make that grant request, and they actually produce the check. So grant, and then it goes to the recipients. When you make the donation is when you get your your deduction. That's when you list it on your itemized deductions. That's why you were able to give multiple years of grants, multiple years of donations into one envelope, one donor-advised fund, and you were able to exceed the new standard deduction. Does this all make sense? That's the idea. So the power of bunching. Successor is written down there because I want you to know that if you die, you can set it up that you could actually have your kids be the ultimate givers of that money. They become the new advisors under the donor-advised fund. So they can actually decide that they want to give it to charities, and they can kind of carry on your legacy of giving. If you don't put a successor down, then of course the institution you gave the money to, Schwab, for example, or Vanguard, they become the giver. And I don't think anyone really wants Schwab deciding where your money was going to go. I think you need to have a successor, and it should be probably a kid. So that is tool number one. I'm going to tell you it is not the very, very, very best tool if you're over the age of 70 and a half, because there's a better tool. But this is good for people who are under the age of 70 and a half. So moving on to tool number two is this idea of giving to charity directly out of your IRA. So your IRA is already tax deferred. You've never paid tax on it. When it comes out of an IRA, you have to pay tax. But if you give it directly to a charity, the government says no tax is owed. So in a way, giving it directly out of your IRA is like getting a deduction. It's money you've never been taxed on. So when you hit 70 and a half, you're allowed to do this. And it also, the wonderful thing about it is that everybody, when you hit 70 and a half, you're required to take out a minimum amount of money out of your IRA. The government literally wants their tax dollars finally. So they're requiring you to take out a minimum amount based on your age. If you give to charity, they'll subtract it from the required amount that you have to take out. So you could, theoretically, look at your IRA, you can do the calculation, it says you have to take out $15,000 out of your IRA, and you say, well, gosh, I give $15,000 to charity all the time. I'd like to just give $15,000 out of my IRA, and then I don't have to give the government any tax dollars? And the answer is absolutely. That's what's powerful about this tool. So I'm going to go through an example of it really quickly. I won't go. All these are looking similar to you, but this one has a distinction about charitable giving. Here's a couple that, here I'm back to couples, but I did do singles. So a couple, income $86,000, all those sources, itemized deductions. Notice I put a big check mark next to charity. So they gave money to charity, and it all added up, all their deductions, including the charitable giving, to $23,000. They had those personal exemptions. Those are long gone. Fast forward to the problem. The problem is same exact income. They gave money to charity. It didn't matter. It all added up to $18,000. Why? Because their investment fees don't count. Tax prep doesn't count. It didn't add up to much. $18,000. They compare it to the new standard deduction, which is really big. And so all that charitable giving had no deduction at all. That's the problem in a nutshell. Here's the first habit that you have to break if you're over the age of 70 and a half and you want to get a deduction for your charitable giving. I don't want you writing a direct check to a charity anymore and putting it in a little envelope that you gave $50 to Father Fred and give it to your tax preparer. This is not going to help you if you're a standard filer. So here's an example of the person making the bad habit mistake. They decide they're going to give $8,000 more to charity. So they write a check for $8,000, and you'll notice on the left, the IRA, they were taking out 15, now they're taking out 8 more. They go inside their itemized deductions, they write down that I gave $8,000 more to charity. You look inside that itemized deductions and they added it all up. It was 18, now it's 26. They have 26,000 of itemized deductions, doesn't help them. The big X, right? Like that, what's that show, that game show with the X. Can't remember what it is. But anyway, there it is, the X. They don't get any benefit for that $8,000 because the standard deduction is what applies. And so this couple ended up with higher income. Why? Because they decided to take money out of their IRA, put it in their bank account, then they wrote a check, $8,000 to their charity. Big mistake. Higher income, they didn't get an ounce of additional deductions. They're just paying higher taxes. This is the nightmare scenario for people who are actually taking money out of their IRA, putting it in their bank account, and then writing a check to charity. This is what they should have done. They give the $8,000 directly to the charity through the IRA. So they contact their advisor, they contact whoever it is that's handling their money, and they say, I'd like to give a direct donation out of my IRA today for $8,000. Once they did that, you'll notice the charities didn't change it. The charitable donations inside of the itemized deduction doesn't change at all because they didn't really donate it. They just gave it directly out of their IRA. The government decided to look the other way when you gave the money. That's kind of the way it works. They don't want you to write down that it's income, and they don't want you to write down that it's a deduction. It's as if it didn't exist. Just money goes out. The only benefit is they say that $8,000, if you didn't take out enough from your IRA to meet your required distribution, we'll let you count that $8,000 as if it counts towards that RMD, they call it, required minimum distribution. So you add it all up, they still have $18,000 of itemized deductions. They still get the standard deduction of $26,600. And this couple has no change in income, no change in deductions, same exact tax as before, but they were able to give $8,000 to charity. The previous example, they had to pay higher taxes because of that simple habit of writing a check. So break that habit and use your IRA for donations. So that is tool number 2, and it's called a qualified charitable distribution. You can just say IRA charitable distribution. Every advisor knows what you're talking about. But this is an important tool for those age 70 and a half. Okay, so now I'm going to ask this group, and I'm sensing just by looking out at the crowd, how many of you really care about the small business deduction and want to hear about it? It does. Okay, good. I'm going to go through a few slides, really high level, and kind of give you a flavor for what changed here, because it's not small. In my life, it's not small at all. It's actually very big. So at the very, very front end, the biggest change in the tax law for corporations are that large corporations that are called C Corps, it's part of the tax code, is a subchapter C corporation. So if you think about the biggest companies you know about, they received a massive, massive tax cut. Corporate taxes were like 35%. No one really paid that. They had a bunch of loopholes to get around that. It was much lower than that, but 35%. They lowered that all the way to 21%. So it was a huge tax cut for big, big corporations. And I can tell you that the senators and the congressmen and the president felt a lot of pressure from people who also run businesses, but they run what's called a pass-through business. S Corps, LLCs. That's the majority of small businesses in America are run out of a pass-through corporation. What that means is this. I have a business, I have revenue, I have customers, I have money flowing in, I've got expenses. I add it all up and I have profit. And all of my profit does not get taxed at a corporate level. It flows right onto my personal tax return where I pay taxes. So it passes right through the corporation onto my personal tax return. It's as if the tax entity doesn't really exist. And so if you have high income, you pay higher taxes on your business profit. If you have lower income, you pay lower. And so they felt the need, and I'll tell you, it was one senator in Wisconsin. He pushed. There were literally 3 senators that had all the cards. The one in Wisconsin, forgot his name already after a year. He pushed for this small business tax deduction, it's a very large tax cut for small businesses that run as pass-throughs. And that also is the same for a sole proprietor. So even if you run a business that's not an LLC or an S-Corp, you're still going to get a tax deduction as a sole proprietor. But there are rules, and they're bizarre. They're complex. And so everything I said about the personal tax return that I said, simple, 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 everything got easier, no standard deduction, no itemized deductions for most people. You could do your taxes a lot more easily. If you run a small business, it is the opposite of simple. It's the opposite of simpler. It is more complex, period. So accountants are pretty happy about this if they're doing business taxes. Okay, the 20% small business deduction is 20% of your income, essentially, for a lot of people. So it's a very large deduction when you apply a 20% deduction to it, to your income. But they wanted to separate, well, they separated businesses into different types. And I put these phrases on here. Believe me, Congress didn't call people paper pushers, and they didn't call people makers and sellers. But I call them paper pushers because they said, we're going to categorize what we call a qualified business. And then the flip side of that is that you're really not qualified to do it. They set up some rules. The non-qualified businesses, where they would say this doesn't apply, and I'll tell you when it doesn't apply, are kind of businesses like me. You know, they're sitting around pushing paper, reading computer screens, thinking about stuff, talking on the phone. You know, all I get is a paper cut for what I do. As opposed to people who run a grocery store or do something physical, running a construction company, or making widgets of some sort and selling them. That's like real, like a real business. You know, paper pushers, accounting firms, doctors' offices, physicians, they're not as real to Congress under these laws. Those are considered kind of like businesses, but kind of not. They're businesses, believe me, but the government looks at them differently. So there's two different kinds of categories, and they have different rules. So the very first rule is that you have to look at the income of the business to figure out what kind of deduction there's going to be and whether you qualify. Here's the rule. As long as you don't have income that's above $315,000, no matter whatever kind of business you have, and I'm talking about your overall income as a couple or as a single person around $160,000. If you are below those levels, you are going to get, no matter which kind of business you run, a paper pusher or a maker and a seller, a real business, you're going to get a deduction that applies to, is going to be a 20% deduction on your income. The way that income is calculated is complex, and I'm not going to get into it. It's important for you to talk to a tax preparer for this. I will say something, by the way. I'm giving tons and tons of tax advice. I'm supposed to say in my industry that this is not actual tax advice, that you should go talk to an accountant. You should go talk to your accountant. I believe that. It's all pretty accurate here. But it's important for you to go to the people who actually do this every day and can apply it to your particular situation. So as long as you don't make too much in your business, in your life, you can be a paper pusher or a real business. And they don't really care. It's when you go above those levels that the paper pusher gets that deduction phased out. So it slowly disappears. And I'm not going to feel bad for people that a married couple where there's a business owner and they're making over $315,000 and they start making $350,000, $370,000, the government starts to shut down this big 20% deduction on your income. I mean, I'm really not going to cry about it. The only thing that makes you want to cry is I don't get why a paper pusher is any different than, ironically, an architect. Did you know that they actually decided to carve out of the paper pusher category architects and engineers? Well, because those people must be designing something real, like a bridge or a building, not just something that's, you know, on paper. So they actually did do major little lobbying at the end that said, well, that's not really a paper pusher because they must make something real out in the real world. You know, they design a road. So anyway, phasing out of the deduction once you get above certain income levels. So be prepared that as your business is more successful, that deduction that they were giving you is going to start to disappear. Okay? That's what paper pushers live under, but that's not what a real business lives under. And I do have a clicker. There we are. A real business has no phase out. But they have a much, above certain income levels, they have a much more complex calculation to deal with. So the benefit of the paper pusher is you make too much money, your deduction phases out. The benefit is you don't have a really complex calculation to figure out. So that's really great. You lose your deduction, but you don't have to do a bunch of math. But if you're a real business, you still qualify for a 20% deduction, but they look at it in a three-way, really a two-way test with three separate calculations. It's very bizarre they came up with this, but this is what they did. They said, first off, we're going to look at your business profit, and we're going to apply a 20% deduction on that. And I'll tell you, if you've got multiple partners, it's the partner's income that they're talking about. So it might be 3 partners, each earning a third, a third, a third. They're going to look at the third that this partner got, and they're going to apply a 20% deduction. A third that this one got, 20% deduction. They look at that and they say, okay, we're not done there. Hold that aside, 20% of your income, that's a possible deduction for you. But we're going to compare it to how much you pay in wages to people. So they're trying to incentivize businesses to have workers. They get paid money. A lot of money. That's better. The more money that you pay your worker, the better, because the bigger deduction you're going to get. I mean, talk about giving money to charity to get a deduction being a little bit of a backward way of thinking about it. Well, running a business, you don't just want to pay a bunch of workers to get a deduction. You want to pay workers to do a particular job to make profit. So wages are part of the calculation that they look at, and it's 50% of your wage base. That's going to be the number we'll calculate the deduction on. Or we're also going to look at wages, a smaller portion of the wages you pay, and how much you invested in the business. Because they also want you to invest a lot of money in your business. The more you invest, the bigger deduction you'll get. So they make this three-way calculation. Someone's got to do all this math, and then they calculate what your deduction is going to be. Very, very complex, but very, very lucrative. So just remember, we've got a breakdown of 2 different kinds of businesses, paper pushers and real ones. Paper pushers are doctors too, and lawyers. So high-income people that are specialists, for example, they don't get this deduction by and large because they make potentially way over $315,000 or way over $160,000. It's the real businesses that actually get this benefit going forward. So if you ever hear from anybody that says, well, I heard that a service business doesn't get a deduction, they're wrong. In fact, they put out 184, I'm talking about they being the IRS, because the law was passed so fast with such massive complications about what all this meant. They put out a 184-page clarification document in July. 184 pages. And I'm a paper pusher, and so I cared a lot about how this worked. So I read it, not all of every page. I would not be able to do that. But I read the pertinent pages. 184 pages, and they clarified what each business category really meant and what it was. And so it became very clear at the end of this 184 pages that businesses that make less than a certain threshold, no matter what kind of business you are going to get a very, very large deduction, and it will have a pretty big impact on your taxes. So I hope that that was fast enough but gave the people who own small businesses something to work with. And with that, that is the end of the program. I will go to Q&A. I went literally almost on 1 hour, so I'm sorry about that. But I have time for Q&A. 3 partnerships here, 3 cooperation senior center. If you've not been to the senior center, go there. It's wonderful. Great programs, not just the money series. And also Leland Township Library. They've got a fantastic program director out there, and I'm very impressed with her. Small little groups of 7 to 15 people are at those programs. Lots of interaction. So if you happen to be in Leelanau County, when we're doing a Money Series program. Go to moneyseries.org. You can find out when we're doing it. I'm doing another one on the tax law, this exact program, but we're going to do it out in Leland, I think, in December.